Usually when we talk about evolution and extinction, we picture like a sudden, violent meteor impact.
Right, the classic dinosaur scenario.
Exactly. The dinosaurs are just going about their day, doing their thing, and then boom, fire in the sky.
And it's a very dramatic visual. The old rulers are simply gone in an instant.
Yeah.
And a totally new biological era begins because the environment literally exploded.
Right. But sometimes an extinction-level event is a lot slower. It's significantly less fiery. In fact, sometimes it doesn't look like a meteor at all.
No, definitely not.
Sometimes an extinction-level event looks exactly like a spreadsheet.
A spreadsheet containing some very, very concerning numbers, I might add, especially for the people who used to consider themselves the apex predators of the world.
Exactly. And that spreadsheet is the main focus of our custom-tailored deep dive today, designed specifically for you. We are exploring a super comprehensive 2013 Boston Consulting Group report. It's titled Survival of the Fittest.
Such a fitting title.
It really is.
Yeah.
And we're going to use it to decode the high-stakes, rapidly shifting, and frankly ruthless world of global capital markets and investment banking.
Which we'll just refer to as CMIB for short, because that is a mouthful.
Yes, CMIB.
And it really is a fascinating snapshot of an industry in total existential crisis, because the central premise of this report is that the absolute golden era of banking is dead.
Completely gone.
Right. We are talking about an era where these institutions routinely, almost effortlessly, saw a 15 to 20% return on equity.
Or ROE.
Right, ROE. And that era is completely over.
Dead and buried. And that's what makes this so compelling. Banks are facing a reality where survival is no longer guaranteed simply by being massive or historically powerful.
Yeah, being big isn't enough anymore.
Exactly. Today, we're going to break down the invisible forces that are actively reshaping where the world's money flows and how the institutions that actually survive this extinction event are being forced to evolve.
And to really grasp the magnitude of this, you have to view the situation through the lens of evolutionary biology, just applied to the global economy.
Yes, because whether you are a business strategist trying to pivot your own company or an investor managing your portfolio, or even if you're just insanely curious about how the global financial machine actually works under the hood, this is a masterclass in how complex systems adapt under extreme stress.
It really is.
So let's get right into the first major issue the report identifies: the big squeeze.
The squeeze is incredibly visceral in this 2012 landscape. To understand the sheer panic occurring in these banking boardrooms, you just have to look closely at the plummeting returns.
The numbers are pretty wild.
They are. We just mentioned that a 15 to 20% return on equity used to be the industry standard. It was expected. But by the end of 2012, the industry average ROE had plummeted down to the 10 to 13% range.
Ouch.
And it gets worse. The BCG report estimates that a further 3 percentage point drop is still baked in as new regulations fully kick in. So you are looking at a near future where ROE might hover around like 7 to 10%.
Which, I mean, if you're an investor, putting your capital on the line is barely worth the risk.
Exactly.
You might as well put your money somewhere safer if the returns are that low. But the report highlights that it's not just the profits are dropping. The actual cost of keeping the lights on, the real machinery of banking, is skyrocketing.
Precisely. You look at the cost-to-income ratio. In 2008, it was around 53%.
Okay.
By 2012, that had ballooned to 73%. It is becoming incredibly unsustainably expensive to operate a traditional bank.
That's a huge jump in just a few years.
It is. But what is truly alarming for the industry is that this pain isn't being distributed equally.
Right.
A massive, basically insurmountable divide is opening up between Tier 1 banks, the absolute global giants, and the Tier 2 mid-sized banks.
Okay, let's unpack this, because the capability gap the data shows here is just wild.
It really is.
You'd assume that in a macroeconomic crisis, all banks are suffering together, right?
Right.
But Tier 1 banks are somehow developing these massive front office productivity advantages.
They are.
The report points out that a Tier 1 bank is seeing 90% more revenue per salesperson in their rates business compared to a Tier 2 bank.
And the gap gets even more extreme when you look at equities. Tier 1 banks are pulling in a staggering 124% more revenue per trader.
Wait, really? 124%?
Yeah. Think about the mechanics of that. One single trader sitting at a top-tier bank is producing more than double the revenue of a trader sitting at a mid-tier bank.
And it's not because the Tier 1 trader is biologically twice as smart. or working twice as many hours.
No, definitely not.
It's the infrastructure beneath them. It's like a Formula One race.
Oh, I like that comparison.
Yeah, so the leading teams are maintaining their massive R&D budgets to keep their cars aerodynamically perfect and their engines fully tuned. Meanwhile, the back markers, the teams running out of money, are forced to cut their engineering spend just to buy tires. Very quickly, they aren't even competing in the same race anymore.
That is the perfect analogy, especially when you look at the lifeblood of modern trading, which is IT budgets.
Right.
In 2012, Tier 1 banks managed to keep their IT budgets completely flat.
Which is saying something.
It really is. In a crisis where revenue is dropping, maintaining your massive tech spend is essentially a victory. They held the line.
But the Tier 2 banks?
Their IT budgets were already only about 40% of what their larger rivals were spending.
Oh, wow.
And yet they still had to slash that IT spend by 10%.
They are literally starving their own engines just to stay on the track.
Exactly.
But this widening gap isn't occurring in a vacuum. It is being aggressively accelerated by two massive external pressures that are crushing the entire industry from the outside in.
Yes, the twin engines of this financial evolution, regulation and technology.
The twin hammers. Let's dig into regulation first, because post-2008 financial crisis, global regulators did not come to play.
No, they did not.
They wanted to fundamentally change the DNA of banking.
They absolutely did. The report breaks down what it calls a 10 percentage point ROE penalty imposed by new regulations.
10 points.
Right. We're talking about frameworks like Basel III in Europe and the Dodd-Frank Act in the U.S. The core mechanism of these regulations is forcing banks to hold significantly more capital in reserve.
Just to prove they can survive another crash.
Exactly, which inherently limits how much profit they can generate because that capital is just sitting there.
It's like being told you have to keep half your poker chips in your pocket at all times.
That's a great way to put it.
It's safe, sure.
Yeah.
You aren't going to go completely bust on one bad hand. But because you can't put those chips on the table, your potential to win big hands is mathematically crippled.
Exactly. You've hit on the opportunity cost of regulation, and the most massive specific impact of this is falling on over-the-counter or OTC derivatives.
Yeah.
Historically, OTC derivatives were bilateral agreements between two parties. They were opaque, highly customized, and wildly profitable for the banks who acted as the middlemen.
Because nobody else knew exactly what the pricing was, right?
Precisely. But the new regulations are dragging this entire market into the light. They are forcing these trades into central clearinghouses.
Making them visible.
Right. And for the trades that can't be cleared, they are slapping huge initial margin requirements on them. It is a massive height in liquidity costs. We are talking about estimates of up to $1 trillion in initial margin requirements globally.
$1 trillion just locked up, sitting there as a safety buffer. That is an enormous drag on profitability.
Huge.
But that's only half the squeeze. Let's pivot to the tech side of the equation. Electronification.
Yes, the report measures how different asset classes are moving up what they call the electronification maturity curve.
What does that mean exactly?
It's essentially a measure of how automated and digital a specific market has become. Now, things like cash equities and foreign exchange FX are way ahead of the curve. Okay.
They are over 50% electronic. Spot transactions in FX are almost entirely digital now, executed by algorithms in milliseconds.
Right, because a dollar is a dollar, a euro is a euro. It's highly liquid and easy to digitize.
Exactly.
But then you have something like corporate credit, which is lagging way behind. The report notes it's under 20% electronic because there are tens of thousands of different highly specific corporate bonds. It's incredibly fragmented.
Very true.
But wait, I have to push back on something here.
Sure.
If electronification makes trading faster, fully automated, and theoretically cheaper to execute, shouldn't that increase bank profits? Why is the report describing this technological leap as something that is actively squeezing their margin?
What's fascinating here is the underlying mechanism of price transparency. You have to think about how banks historically made their money.
Okay.
When a market is opaque and trades are negotiated over the phone, the bank acts as the gatekeeper.
Yeah.
They have a better view of the overall market prices than the client does.
Because of that asymmetry of information, the bank can charge a premium for executing the trade. That difference, the bid-offer spread, is pure profit.
Oh, wow. It's like trying to sell a used car, but suddenly every single buyer walking onto the lot has an app showing them the exact wholesale cost you paid for the vehicle at auction.
Yes.
The premium you used to charge for your, expertise as a dealer vanishes instantly.
Exactly. When a market goes fully electronic, everyone sees the exact same price at the exact same time. The product becomes entirely commoditized.
Right.
You can no longer charge a premium for the trade itself, and to even survive in that transparent environment, a bank is forced to pour hundreds of millions of dollars into e-commerce IT just to play the game.
Wow.
You have to have the fastest algorithms and the deepest server farms. So you are spending a fortune to compete in a high-volume, incredibly low-margin arena.
That sounds brutal.
It is. The report notes that cash equities alone command hundreds of millions in IT spending per year for a single Tier 1 bank.
So if we synthesize this, the cost of doing business has skyrocketed because regulators are forcing you to lock up your poker chips, and your profit margins have completely evaporated because technology has made all pricing perfectly transparent.
Perfectly said.
Because of that brutal combination, banks can no longer afford to be everything to everyone.
They simply can't. The historical model of the universal bank, where a single institution does every type of financial transaction for every type of client, is basically breaking down.
Yeah.
They're being forced to make brutal, surgical decisions about exactly what they do and who they serve.
Which brings us to the pruning phase. The BCG report says banks have to evaluate their entire business structure through two very specific lenses, the client lens and the product lens.
Let's start with the client lens. The phrase client centricity gets thrown around as corporate jargon a lot, but in this post-crisis landscape, it is about literal survival.
How so?
A bank has to figure out exactly who they are dealing with and tailor their infrastructure to match. Imagine you are serving a massive multinational counterparty, like a giant asset manager.
Okay.
They don't need hand-holding. They want flawless, lightning-fast trade execution, raw market data, and innovative structuring. They provide massive volume, so you have to build high-speed infrastructure for them.
But if your client is, say, a mid-sized corporate manufacturer in the Midwest, they don't care about your high-frequency trading algorithms in London.
Not at all.
They want a deep personal relationship. They want a one-stop shop where they can get a loan to build a new factory, foreign exchange services to pay their overseas suppliers, and maybe some advisory help if they want to acquire a competitor.
Right.
You have to align your entire offering to exactly what that specific client profile actually values, or you're wasting money.
Which leads right into the product lens, because once you know your client, you have to ruthlessly evaluate the products you're offering them. You can't keep every desk open anymore. The report introduces a rigorous screening process where banks must interrogate every single product line from multiple angles.
And this isn't just a simple does it make money test, is it? It's much more complex.
Oh, much more. Profitability, the economic angle is just the starting point. You have to look at the operational reality. Is this product an absolute nightmare for your back office to process?
Good question.
Does it require an army of compliance officers? You have to look at the strategic value. Even if a product barely breaks even, does offering it allow you to cross-sell highly profitable services to that same client?
Wow.
And crucially, you have to look at market share. If you aren't a top-tier player in a specific product, do you even have the scale to survive the margin compression we talked about earlier?
So after you run a desk, say your commodities division or your European equities team through that gauntlet, you have to categorize it. You have to sort it into one of three buckets.
Right. The first bucket is fully fledged. This means you have significant size, a true competitive advantage, and the margins make sense.
Okay, the winners.
Yes. This is the core of your business, where you focus your heavy human and IT investments. The second bucket is presence.
Meaning you just need it on the menu.
Exactly. You keep the operation extremely lean. You might even white label the service, meaning you essentially buy it from a bigger bank and slap your logo on it, just so you can offer it to your core clients who demand a full suite of services.
Got it.
You don't expect to dominate the market, you just need to be present. And then there's the final category, exit.
Just drop it.
You cut the product from your portfolio entirely, you fire the traders, sell the tech, and walk away.
Now, before we get to what the banking ecosystem looks like after all this cutting, I want to bring up something that feels like an obvious escape hatch.
What's that?
What about rapidly developing economies? The RDEs. The report mentions they account for roughly half of the sales and trading revenues in the Asia-Pacific region. Since these emerging economies are growing so fast, aren't they the saving grace? Can't a struggling European or American bank just pivot to RDEs to escape the low returns at home?
It's a very logical question, but The report explicitly warns against this strategy. It calls it the RDE challenge.
Interesting.
The volume of money is certainly there, but the ability for a Western bank to actually capture value is incredibly difficult.
Yeah, the RDE illusion. Break down the mechanics of why that's an illusion.
It basically comes down to fiction. First, accessing those lucrative clients is fundamentally harder. You are dealing with top local companies that are fiercely loyal to regional players.
That makes sense.
Second, the nature of the wealth is different. You have heavy government and family influence. You aren't flying in to pitch to a standard corporate board with transparent metrics.
Right.
You are trying to navigate state-owned entities and entrenched family dynasties whose business is built on decades of deep, localized trust.
So these are relationships you can't just buy your way into with a slick PowerPoint and a good algorithm.
Exactly. On top of that, the markets themselves are highly fragmented across different regulatory regimes, which drives up your operating costs and kills your margins.
Yeah.
And finally, the local talent required to navigate all this is incredibly scarce. Global banks often try to solve this by using a hub-and-spoke model, running everything out of a major financial center like Hong Kong or Singapore. But that completely sacrifices the local proximity and cultural nuance they actually need to win the business on the ground.
Wow. Okay.
So no, pivoting to RDEs is not a magic parachute for a struggling universal bank.
Okay, so the reality is there is no escape hatch. You have to face the music, you have to make the hard choices and put things in the exit bucket. And it brings to mind an analogy. It's like pruning a massive ancient oak tree.
Oh, I like that.
Right. If a bank's leadership decides to chop off a major branch like totally shutting down their commodities trading desk, the report notes it takes at least 5 years of intense, sustained investment to ever grow that capability back.
At least 5 years.
Yeah, you can't just chop it off to save money this year and then decide to glue it back on next quarter when the market shifts.
It is a permanent structural alteration to the institution's DNA.
So when you take all the banks in the world, you subject them to these exact same regulatory capital requirements, you expose them to the exact same technological margin compression, and you force them to ruthlessly prune their oak trees. They don't all look the same at the end.
They don't. The extreme pressure of this environment forces them to mutate in different directions based on their inherent strengths.
Right.
And the report identifies 6 distinct evolutionary survivors that will make up the new global financial ecosystem.
The big 6. Let's walk through who actually inherits the earth here and how they interact.
At the very top of the food chain, you have the apex predators. The report calls them the powerhouses.
Powerhouses.
These are the Tier 1 banks that survive entirely on massive scale. Because they have those huge IT fixed costs we talked about, they rely on moving a breathtaking volume of standardized flow products to stay profitable.
Cool.
They are the market makers. They control the massive liquidity pools. We're talking about a targeted ROE of 15 to 16%, but only for the absolute 2 or 3 global players who can actually sustain the volume.
So they are like the Walmarts or the Amazons of global finance. Massive volume, razor-thin margins per trade, but perfect technological logistics.
Exactly.
But obviously, not everyone can be a powerhouse.
Right. Which brings us to a completely different species, the haute couture institutions.
I love that name.
It fits their mechanism perfectly. They are the bespoke tailors of the financial world. They focus on high-margin, incredibly complex product creation.
Who are their clients?
They cater almost exclusively to hedge funds, private banks, and sovereign wealth funds who need customized solutions. They don't need the massive daily trading volume of the powerhouses.
Right.
Instead, they need elite, human capital top-tier quantitative analysts and financial structures. If they manage their risk correctly, they can hit 16 to 18% ROE.
High risk, high reward, very custom. So that scale and that specialization. What about the mid-market?
That space is dominated by the relationship experts. These are the banks that use their high-quality balance sheets to offer direct financing to mid-market corporate clients.
Okay, so loans, basically.
Exactly. Financing is their wedge. Once they give a client a crucial loan, they use that deep, reliant tie to become their one-stop shop for everything else. Hedging, cash management, payroll.
Smart.
They aren't trying to outtrade the market algorithms. They're trying to own the client relationship entirely. They operate on a very stable 13 to 14% ROE.
Slow, steady, and sticky. They build a moat around the client. Okay, what about the players taking on the really aggressive risk now that the banks are heavily regulated?
That falls to the hedge funds. This is a fascinating direct result of the regulations like the Volcker Rule, which effectively forced proprietary trading banks trading their own money for profit out of the big banks and into the shadow banking sector.
Wow.
Hedge funds are seeking pure alpha. They are stepping in to take on the market risk the banks aren't legally allowed to hold anymore. Because they are less regulated, the top performers here can push 20 to 25% ROE.
25%.
Yeah,
They are the scavengers taking advantage of the new rules, eating the lunch the banks were forced to leave on the table.
pretty much.
But here is where the ecosystem gets really interdependent. Let's talk about the utility providers.
Yes, this is a crucial mutation. These are often non-banks entirely. They are specialized software vendors, massive data providers, and independent clearing firms.
Okay.
Remember how we said Tier 2 banks had to slash their IT budgets and couldn't afford to build their own e-commerce platforms?
Right, they were starving their engines.
Well, their survival mechanism is to outsource their back-office operations to these utility providers. Ah, I see.
The utilities absorb the complex IT and processing operations of multiple banks, building massive economies of scale that no single bank could achieve alone. They become the literal plumbing of the global financial system, pulling in a very healthy 15 to 17% ROE.
Incredible. And finally, the sixth survivor, the advisory specialists. These are your boutique M&A mergers and acquisitions experts.
Yes.
And here's where it gets really interesting. Look at their ROE compared to the rest. While the giant powerhouses are fighting tooth and nail, spending billions on tech just to maintain a 15% ROE, these boutique advisory specialists can achieve ROEs in excess of 30%.
It is a staggering number, but when you dig into the mechanics, it makes perfect sense.
So,
Why are they so profitable? Because their business model is driven almost entirely by human talent and relationships, not massive IT server farms or heavy capital requirements.
right. Regulators aren't forcing an M&A boutique to hold $1 billion in safety capital because they aren't taking on market risk. They are just giving advice. Their cost structure is variable. If they negotiate a massive merger, the bankers get a huge bonus. If they don't, their base operating costs are relatively low.
It's pure brain power monetization.
If we connect this to the bigger picture, this list of 6 survivors represents a profound shift in financial history. We are watching the era of the monolithic, we do everything for everyone universal bank fracture right before our eyes.
That's crazy.
It is breaking apart into a highly specialized, deeply interdependent ecosystem. You have the powerhouse doing the raw execution, the utility provider handling the back-office plumbing, the haute couture shop designing the complex derivative, and the hedge fund buying it to take on the risk.
It really is a brand new financial food chain. So what does this all mean for you listening right now? Why does this BCG report from over a decade ago matter to your life today?
It's a great question.
Well, whether you are looking at your own retirement portfolio's performance, or you're watching a modern tech company ruthlessly outsource its operations to cloud providers, or you're just reading the headlines about banking regulations and wondering why a massive famous bank suddenly shuts down an entire trading division, you now have the decoder ring.
You understand the underlying mechanics driving those headlines.
Exactly. You understand that invisible forces of capital constraints, technological commoditization, and strict regulation dictate corporate survival. It's no longer just about who has the smartest traders in the room. It's about who can adapt their biological makeup to a completely new, unforgiving climate.
And this raises an important question, something to really chew on that isn't explicitly resolved in the original report. We talked extensively about those utility providers.
Right, the non-banks absorbing the outsourced IT, the data, and the back-office operations to save the remaining banks' money.
Yes, the new plumbing of the ecosystem. Well, think about the logical conclusion of that trend. If all the surviving banks, the powerhouses, the relationship experts, the boutiques decide to outsource their complex, expensive compliance and trading IT to just a few massive centralized utility providers, what happens when one of those unregulated utility providers gets hacked? Or what happens if their servers go offline for just 24 hours?
Oh, wow. If they're handling the processing for 20 different banks.
Exactly. Have we just solved the 2008 problem of too-big-to-fail banks by inadvertently creating a hidden, centralized single point of failure for the entire global economy?
Now that is a terrifying thought. The extinction meteor isn't aiming for the giant dinosaurs anymore. It's aiming directly for the plumbing they all rely on. Thank you for joining us on this custom deep dive. Keep questioning the invisible systems around you. And remember, survival doesn't always go to the biggest. It goes to the fittest.